Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Steve Wyett, chief investment strategist with BOK Financial, to discuss the bank sector and potential regulatory responses to lower risk. Steve, it's great to see you as always. Welcome back to Trade Talks.
Hi, Jill. Thank you for having me, man. What an interesting time for us to have a conversation today.
Yeah, it certainly is. And Steve, I think everyone's knee-jerk reaction was, oh, is this like 2008, 2009? How's the current unrest in the banking sector different than previous episodes?
Yeah, it's really interesting, Jill. Look, I can go back to the early 80s when I got started in the banking business. And if you just looked at periods of time where we had duress in the financial sector, it was almost always started with a credit issue. And what was really interesting about this is it started with a liquidity issue and the fact that Silicon Valley Bank had large losses in their bond portfolios, which they didn't hedge, they didn't manage that risk. And so it really just came from a different perspective, different than what we had seen in the past. And it happened really quickly. And I think that was the big difference, is just the fact of where the losses came from, a bond portfolio. Keep in mind, after the financial crisis in 2008, 2009, government bonds were the area where the regulatory authority said, hey, you can invest your money in this sector and not have to allocate any capital to carry those bonds. So in some ways, Silicon Valley did exactly what the regulatory authorities had thought was the lowest risk part of the banking balance sheet. But when the Fed raises rates as aggressively as they did, obviously we know if it wasn't credit risk, it was interest rate risk that got them.
Yeah, well, it's mind-blowing to me is they operated without a chief risk officer for nearly a year. It's not the most sexiest position. You never hear about the risk officers until something goes wrong, but they are, in fact, one of the most key people in the C-suite for any institution. So what do you think possible regulatory responses could be?
Yeah, I think, look, Jill, you never have something like this happen without people calling for some sort of reforms to, we write policies and procedures because something bad's happened and we want to write a policy or procedure so that doesn't happen again. I think the changes could be really all over the board, everything from the way that banks carry bonds available for sale, held to maturity. They may take away the option for banks to park bonds in a held to maturity bucket, just because that's where a lot of that risk, at least from a quarterly reporting standpoint, was hidden. To your point, Jill, this wasn't some esoteric off balance sheet derivative kind of risk that got them. This was right in front of everybody. It was just interest rate risk. So I think that there could be some changes to how they allow banks to carry. There may be some changes to the capital allocation if you're carrying longer term bonds or bonds that have different kinds of extension risks like mortgage-backed securities or something of that nature, that even though they're government guaranteed from a credit risk standpoint, you might have to carry a little capital to cushion the potential for market value changes while you hold those bonds.
And we've already seen tighter lending standards before the banking volatility. So what do you think happens now?
Well, ultimately, when banks see additional risks, they start to cut back. And to the degree that the majority of the risk that banks try to manage is credit risk, as other types of risk, in addition to credit risk, grow, I just think you'll see banks pull back on the amount of risk they're willing to take. And so we think that that's going to mean that access to credit for our economy is going to become harder to get. Historically, as that has occurred, that flow of credit is so important for economic growth. And as that slows, that certainly becomes just an additional headwind for the economy. It reduced our economic outlook as we think about moving forward from here. And I think it increases the chances of a recession and probably pulls that forward a little bit. And if anything, Jill, it might actually, we have this scenario where maybe we could have a very shallow type of a recession. There's still a lot of momentum in the economy, and maybe we could have some time for the labor market to cool off a little bit without the economy having to slow dramatically. But actions like this deepen that risk of a sharper slowdown as we move forward.
And that's to my next point. Is this really what the Fed wants? Yes, they want the economy to cool down, but if you start taking away jobs and you're restricting capital to smaller companies that are such a crux of the economy, might be too much.
Well, the reality is the Fed wants some of this. They don't want too much of it. I think that was the hard part. That's where it was really uncomfortable talking about what the Fed was trying to do with monetary policy and quantitative tightening to cool the labor market. And even by their own forecasts, seeing unemployment go up by a full percent, which is roughly 1.5 million jobs. That's a really uncomfortable scenario for the Fed to be in. But how the labor market cools, how inflation comes down matters. If it occurs over a longer period of time, it's much less impactful. But if it starts to occur very quickly and we start to see the labor market deteriorate rapidly, if we see inflation move quickly towards 2%, that's not a particularly good outcome. In that sense, the way the bond market has reacted to all this, where they're now calling for 3 cuts between now and the end of the year, that's a pretty negative outcome. And for this Fed to get to that point where Chair Powell has clearly stated that he knows the risks of stop and go monetary policy, if they're actually going to ease this quickly after just raising rates 25 basis points at their March meeting, that would be a really bad economic outcome. And I don't think that's not what we want to have happen.
Yeah, it's a tough spot, Powell and the Fed are in right now, that's for sure. What would you recommend in terms of positioning with this backdrop?
Yeah, I think at this point, look, it's just prudent that if you're thinking about risk and pursuing returns, managing risk or the pursuit of returns, it pays to be a little bit heavier on the risk management side than the pursuit of returns. That doesn't mean that you sell everything. That doesn't mean that's not how most investment plans work. But you would, we're in a position where we've got a little bit less exposure to the equity market than what our longer term strategic neutrals are. A little bit more cash, not carrying a huge amount there. We're actually overweight domestic fixed income. Even if the Fed doesn't have to ease, they're close to the end of their tightening cycle. And man, for the first time in 15 years, short-term rates actually look relatively attractive. Ironically, that's what started this whole thing, was short-term rates getting to 5% or higher. And investors woke up and said, wait a minute, why am I only getting 2 basis points on my bank account when I can go out and buy 6-month T-bills at over 5%? But we think the bond market still has some level of attractiveness to it. The short-term volatility notwithstanding, where we have the 2-year moving 30, 40 basis points in very short periods of time, up and down.
Yeah. All right, Steve, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill. Appreciate it.